Why do some companies thrive while others collapse under scandals like Enron or Satyam? The answer often lies in one powerful framework: COSO, the global gold standard for governance, risk, and internal controls. COSO started in 1980s to fight corporate frauds, but today it goes far beyond financial reporting. Its principles: ethics, accountability, risk appetite, and resilience. They help organizations navigate modern challenges like cybersecurity, sustainability, artificial intelligence, and digital trust. From banks and telecoms to e commerce, tech providers, and healthcare, COSO provides boards and professionals with a compass to link risk with strategy, compliance with innovation, and performance with integrity. Unlike other framework, COSO isn't just a checklist. It's a mindset. It's a bridge that connects regulators, auditors, leaders, and employees in a shared language of trust and accountability. So, if you want to understand how COSO can prepare organization for future from AI and cloud to 5G and ESG reporting, join me in this deep dive. Good governance is not optional, but with COSO, it becomes your foundation for trust, resilience, and long term success. Let's now dive into the part 2 of this series. Welcome. This is your host, Savit Vittal Salian. Let's look at the flow of history. The early 2000s brought another wave of corporate scandals, including Enron, WorldCom, and Tycos, which exposed massive frauds in financial reporting and governance. These failures triggered the enactment of the Sarbanes Oxley Act, or SOX, of 2002, one of the most sweeping corporate governance reforms in US history. SOX required public companies to establish and maintain adequate internal controls over their financial reporting, with 404 section specifically mandating managements and auditors to report on the effectiveness of these controls. While SOC did not mandate COSO explicitly, the COSO ICIF became the de facto standard for compliance. Companies worldwide adapted COSO framework to meet regulatory obligations, and auditors increasingly used COSO as the benchmark for testing control effectiveness. So 1992, well, ICIF launched as the foundational framework. In 2004, COSO released the ERM, extending internal control principles to enterprise-wide risk strategy. In 2013, COSO updated the ICIF to incorporate 17 principles of internal controls, aligning with modern corporate realities. In 2017, COSO updated the ERM framework to focus on strategy, performance, and governance, emphasizing risk appetite and value creation. Between 2016 to 2023, COSO released specialized guidance on fraud risk management, cybersecurity, blockchain, ESG, and sustainability risks. Through these updates, COSO demonstrated its ability to adapt to changing regulatory, technological, and business landscapes, ensuring continued relevance. Let's look at some key concept. Risk appetite. It's defined as the amount of risk an organization is willing to accept in pursuit of its objectives. Risk appetite ensures alignment between strategy, operations, and stakeholder expectations. That's risk appetite. Second is risk culture, a critical determinant of how ERM principles are executed. An ethically transparent culture strengthens risk management, while a weak culture undermines even the best framework. The third is portfolio views of risk, which is instead of looking at risk in silos, ERM encourages a comprehensive view, balancing interdependency and trade offs. The fourth is integration with strategy and performance. ERM is positioned as a decision making enabler. Organizations that manage risk proactively can achieve long term resilience and competitive advantage. Next is holistic approach. Some of the strengths of COSO. We looked at the key concept earlier. So, from a strength of COSO perspective on ERM, it extends risk management beyond compliance into strategy. It positions risk as an enabler for growth. It encourages stronger board and executive oversight. And it's applicable to large multinationals, SMEs, and non profits alike. To compare ERM to ISO 31000, COSO is US based. ISO 31000 is International Organization for Standardization. That's the origin. The focus of COSO is strategy, performance, and governance. And the focus of ISO is general risk management principle. From a structure perspective, COSO has 5 components and 20 principles. ISO has framework, principles, and processes. From an integration perspective, it has strong emphasis on linking to value creation. Whereas ISO is broader but has less perspective, less prescriptive. From a usage perspective, it's popular in US and SOX regulated environment, whereas ISO has a global adoption across industries. COSO ERM's framework has redefined risk management as a strategic discipline rather than a compliance burden. By linking risk to governance, culture, performance, ERM provides organizations with a blueprint for resiliency and sustainability. In an age of cyber attacks, ESG expectations, AI adoption, and global supply chain disruption, ERM is more relevant than ever. Companies that integrate COSO ERM into strategic setting and performance evaluation are better positioned to navigate uncertainty while creating long term value for stakeholders. In today's context, COSO is not just a framework but a global reference point for governance and risk management. From regulatory compliances to emerging areas like ESGs and AI governance, COSO remains central in how organizations design and evaluate their control environment. The historical journey of COSO from a response to fraud in 1980s to a modern thought leader in risk and governance shows how scandals and crises often drive innovations in corporate governance. Just as the Enron scandal led to SOX, the digital era challenges are pushing COSO to evolve into a framework that goes far beyond financial reporting. Beyond ICF and ERM, COSO has issued targeted publications addressing emerging risk and industries. In a fraud risk management space, practical tools to establish fraud risk governance, access schemes, and monitoring controls are defined. From a cybersecurity perspective, mapping COSO principle to cybersecurity or cyber risk management, thus bridging with the NIST on ISO 27001 is seen. These are all publications of 2017. In 2020, it explored opportunities and risks of distributed ledger technologies as part of the blockchain guidance. In 2018 and 2023, there was guidance on integrating environmental, social, and governance risk into enterprise risk strategy that came as the COSO ERM and ESG publication. There is an ongoing discussion on from an artificial intelligence risk perspective. There are early thought leadership on AI governance, biases, transparencies, and controls. That's ongoing. So why are these framework influential? Well, the enduring influence of COSO framework stems from several factors. It's flexible and adaptable across industries, geographies, and regulations. COSO frameworks underpins laws like SOX or PCAOB standards and global compliance regimes. From fraud to cybersecurity, COSO provides a unifying language for governance and risk. Adopted by large corporations, SMEs, NGOs, government agencies, and regulators worldwide. In comparison between ICIF and ERM, the focus of ICIF is internal control, whereas for ERM it is enterprise risk, enterprise wide risk. Objective of ICIF is operations, reporting, and compliance, whereas for ERM it is strategy, performance, and value creation. From a structure perspective, ICF has 5 components, 17 principles. ERM has 5 components and 20 principles. Iconic symbol ICF is COSO cubes. We also have the helix. And from ERM is ERM framework diagram. Application of ICIF is financial reporting, compliance, whereas from ERM perspective is strategic risk, emerging risk, and ESGs. Application across industries. In BFSI sector, it's used to integrate Basel 3-4 requirement into strategic risk management. It supports stress testing, credit risk modeling, and operational risk framework. In telecommunication space, it helps manage regulatory, reputational, and operational risk. Example, assessing risk related to 5G rollout, customer churns, and spectrum allocation. In healthcare, it supports compliance with patient safety and data privacy. It helps manage risk like cyber attacks on medical devices or pandemic responses. From IT and cloud provider perspective, it links ERM to service reliability, third party risk, and SOC 2 controls. It addresses emerging risks like outages, data localization, and AI ethics. In e-commerce and digital platform perspective, it guides fraud detection, digital trust, and supply chain resilience. It balances innovations with risk appetite. The ICIF is designed to be universal and is applied across a variety of sectors. Let's go one level deeper. In BFSI, it supports compliance with SOX and Basel requirements. It ensures accuracy of financial reporting and strengthens anti-fraud programs. In telecommunication, used to implement fraud management control. Example, swim swap or billing frauds. It ensures regulatory compliance with telecom regulators. In IT service and cloud provider, it provides the backbone for SOC 1 and SOC 2 assurance report. Thus, ensures third party clients of robust internal control over financial and operational process. In healthcare, it aligns with HIPAA compliance by ensuring internal controls over patient records and billing accuracy. In e-commerce, it guides fraud prevention and consumer data protection. It strengthens trust in digital transactions. ICIF is recognized as the global benchmark for internal controls. It's widely adopted that way. ICF is applicable to organizations of all sizes and industries, hence flexible. It directly maps to SOX section 404 compliances. So there is an alignment to the regulatory requirement. It incorporates people, processes, and technology into one integrated framework, hence has a holistic view. Despite its strength, COSO ERM faces some challenges. Like for smaller organizations, the full 20 principles may feel resource intensive. It's difficult to quantify and align across diverse stakeholders. Many organizations adopt ERM in theory but struggle to integrate it into decision making. ERM must often coexist with ISO 31000 or NIST CSF or local regulatory models. So let's look at it from one more angle. From a challenge and limitation perspective, for small and medium enterprises, the framework may appear overwhelming. It requires resources, training, and continuous monitoring. The critics argue it is still skewed towards finance rather than operational or strategic risk. While updated, applying the principles to fast changing technologies can be challenging at this point of time. So, why internal control integrated framework matters? Well, despite its limitation, ICIF remains the cornerstone for internal control worldwide. It provides a structured yet flexible approach to designing effective control systems, ensuring that organizations can safeguard assets, maintain accurate reporting, and comply with regulations. More importantly, it reinforces the importance of ethics, governance, and accountability in preventing fraud and managing risk. As organizations face growing digital, operational, and reputational risk, ICIF continues to serve as a foundation upon which modern governance and risk strategies are built. Regulatory alignments. One of the most important reasons behind COSO's enduring influence is its integration with regulatory requirements and audit practices worldwide. While COSO frameworks are not themselves laws, they have become the de facto standards for demonstrating compliance with legal and regulatory mandates, whether in financial reporting, banking, insurance, technology, or data protection. COSO provides the structured methodology regulators and auditors expect organizations to follow. The Sarbanes Oxley Act of 2002 was a landmark US law passed after the collapse of Enron, WorldCom, and Tyco, designed to restore investor confidence through stronger corporate governance and accountability. The Section 302 requires CEOs and CFOs to personally certify the accuracy of the financial report. Section 404 mandates management and external auditors to report on the effectiveness of the internal controls over the financial reporting. Although SOX does not mandate a specific framework, ICOSO's internal control integrated framework becomes the most widely adopted standards for SOC compliance. Reason includes the ICF structured definition of internal control mapped perfectly to the SOX requirement. The external auditors strongly prefer COSO as the evaluation benchmark. The COSO's 2013 update strengthened links to ICFR and fraud prevention. It did it explicitly. Example, banks listed in the US must demonstrate compliance with SOX 404 and mostly rely on COSO's ICIF to design, test, and document controls around loan portfolios, investment banking, and IT systems. From a PCAOB perspective, the Public Company Accounting Oversight Board's perspective, established under SOX, it sets auditing standards for public companies in US. The PCAOB standards are closely aligned with COSO principles. So when evaluating ICFR auditors often test whether COSO's 5 components and 17 principles are present and functioning. The PCAOB guidance on identifying material weaknesses in controls often reference COSO concepts. The PCAOB emphasizes fraud risk assessment, echoing COSO's risk assessment principles. Thus, while PCAOB issues its own standards, in practice, COSO is the yardstick auditors use to judge controls effectiveness. The SEC enforces SOX compliance and has consistently acknowledged COSO framework as an appropriate basis for evaluating internal controls. Companies referencing COSO ICIF in their annual report often face fewer challenges in their SEC reviews. The SEC views COSO as an accepted method of achieving reasonable assurance in reporting accuracies. Enforcement actions often cite failures in COSO components. Example, in SEC action against companies like General Electric or China Media Express, weaknesses tied directly to COSO's principle were highlighted, which was related to board oversight or fraud risk assessment aspect. In the global banking sector, risk management is heavily shaped by the Basel Accord, which set capital adequacy and risk management requirements. While Basel does not prescribe COSO explicitly, the alignment is clear. Basel requirement for bank to manage operational risk aligns with the COSO's ERM principles. COSO ERM provides governance structure to integrate risk appetite with regulatory capital decisions. Regulators often accept COSO based control framework as evidence of compliance with Basel requirement. The Reserve Bank of India requires banks to establish risk governance framework consistent with Basel III. Many Indian banks use COSO ERM to link board oversight, risk appetite, and stress testing processes. As international finance reporting standard adoption expands globally, COSO supports compliance by ensuring financial data integrity, consistency, and transparency. The COSO ICIF underpins internal controls over financial reporting, which supports IFRS requirements. Global auditors often use COSO when assessing internal controls in IFRS compliant companies. In telecom sector, telecom companies face strict regulation around customer data, fraud management, and lawful interception. COSO frameworks helps them. For public listed telecom firms, they help in SOX compliance. COSO reporting controls ensures accurate billing and revenue assurance. The COSO's risk assessment component addresses SIM fraud, roaming frauds, and interconnection billing risk. In Europe, telecom operator map COSO controls to GDPR obligations, ensuring lawful processing of personal data. For IT services and cloud companies, demonstrating trust is critical. Here, COSO aligns with SOC report, your data protection regulations, and third party risk management. Example, the SOC 1 and SOC 2 are based on the COSO ICIF. Service auditor assess whether controls meet the COSO's principle. The COSO principles of information communication and monitoring help them align with GDPR and India's DPDP Act. COSO ERMs provides structure for evaluating cloud vendor risk. Example, a global cloud provider like AWS may undergo SOC 1, SOC 2 audit, where auditor assess whether its internal control environment is aligned with COSO or not. In healthcare, Well, healthcare provider must comply with patients' privacy and reporting requirements. COSO provides the internal control, provides the ERM, and provides the compliance integration as required. It ensures integrity of patients' billing and reporting systems. It identifies risks like cyber attacks on medical devices, pandemics, or reputational damages. It aligns compliance activities across financials, operational, and IT processes. In e-commerce platforms face complex risk around fraud, consumer protection, and data privacy. The COSO framework helps in fraud risk management, helps in ensuring compliance with multiple regulators, helps in building stakeholder trust through reliable reporting and transparent governance. Example, a global platform may use the COSO ERM to align risk appetite with expansion into emerging markets, thus balancing growth opportunities with fraud and cyber security risk. In public sector, while this is designed for corporations, COSO has already been embraced by governments. The US Green Book it adopts COSO ICIF as the standard for internal controls in federal agencies. The International Organization of Supreme Audit Institutions endorses COSO as a model for public financial management. India's CAG and CVC often recommend COSO based framework for state owned enterprises. Challenges. Well, while COSO is widely accepted, challenges related to cost, consistency, and complexity in digital ages are observed. Smaller firms face high cost in implementing COSO based controls for SOX or SOC audits. Regulators in some countries prefer ISO 31000 or local frameworks requiring dual compliances. Applying COSO principles to emerging areas like AI governance, ESG reporting, or blockchain risk is still evolving. From SOX in US to Basel in global banking, from SOC report in cloud services to HIPAA in healthcare, COSO has become the common language of regulatory compliance. Its flexibility allows alignment across sectors and jurisdictions, making it indispensable for boards, regulators, auditors, and management. Regulators trust COSO because it balances rigor with adaptability. It does not prescribe checklist but provides the principle that can be mapped to any law or standards. This universal applicability cements COSO's role as the regulatory compass in governance, risk, and compliance. Let's look at some practical applications of COSO. Frameworks gain significance not only through theory but through practical applications. COSO's internal control integrated framework and enterprise risk management framework are designed to be applied flexibly across industries, functions, and geographies. Their true value lies in guiding organizations to design effective controls, align risk with strategy, embed, in, embed governance in operations, and learn from failures. One of the most practical use of COSO is in control designs. Organizations use COSO's 5 internal control components and its 17 principles as a blueprint for building and evaluating controls. Example, banking. Well, controls to prevent unauthorized transactions, segregation of duties, maker checker, validation, automated reconciliations. As an example, under the banking space, revenue assurance control, cross checking billings records against network usage logs, is a good example from a telecom sector. Logical access control, privileged access management, password policies, and multi factor authentication is observed in the IT service and cloud space. That's a control design that's built on it. In healthcare, you have medical billing controls, prevention of duplicate or fraudulent claims. In e commerce, payment gateway controls, fraud detection algorithms, and real time monitoring of suspicious activities is noticed around the e commerce space. Using COSO, these controls are not seen in isolation but as a part of a system of independent processes tied to organizational objectives. The ERM framework ensures that the risk is not treated as a siloed function but as a strategic enabler. Organizations map COSO principles into their strategy setting process. The risk appetite statement is about board defining tolerance level for financial, operational, cybersecurity, or ESG risk. Example, a bank may accept higher risk in fintech partnership but low tolerance for credit defaults. Under risk integration in decision making, strategic initiatives are evaluated using ERM principles. Example, a telecom operator expanding 5G uses COSO ERM to assess regulatory, cybersecurity, and reputational risk. From a portfolio view of risk perspective, companies aggregate risk across units to see overall exposures. Example, a global cloud provider views outage risk, regulatory risk, and data localization risk as an interconnected portfolio. This alignment helps organizations optimize risk return trade offs rather than simply avoiding risk. COSO is often embedded into GRC platforms that organizations use to manage compliance, audit, and risk. By mapping COSO principles into digital systems, firms can automate control testings. They can track regulatory obligations. They can provide boards with dashboards showing COSO component in action. Example, a BFSI institution integrates COSO into its GRC tool, allowing real-time visibility of risk appetite breaches, fraud alerts, and compliance gaps across global operations. Let's go deeper. Case study 1, the Enron 2001 case. Enron used complex financial structure to hide debts and inflate profits. Board oversight and risk assessments were identified as weak, while the culture encouraged excessive risk taking. From a COSO perspective, the control environment failed, as tone at the top promoted unethical behavior. The risk assessment failed. The board ignored risk in off balance sheet entities. Monitoring failed because internal audit lacked independence. The lesson learned? Well, COSO emphasizes integrity, board's independence, and for fraud risk assessment, principles that could have prevented Enron's collapse. Case study 2, the WorldCom 2002. WorldCom committed massive accounting fraud by capitalizing expenses to overstate profits. Here, the control activities failed, the information and communication failed. Basic reconciliation and approvals were bypassed. The CEO and the finance team concealed data from auditors. Lesson learned? Well, COSO's principle of relevant quality information and independent monitoring could have flagged the discrepancies earlier. Case study 3, Satyam, 2009 India. The IT giant Satyam was engaged in financial statement fraud by inflating revenues and assets. In this, the control environment failed, the risk assessment failed, the monitoring failed. The management culture tolerated fraud. Investors and regulators underestimated the governance risk. External auditors did not independently verify cash balances. Lesson? Well, COSO's fraud risk assessment and emphasis on external communication highlight how robust framework could have protected the investors. Case 4, Wells Fargo 2016. Employees created millions of unauthorized customer accounts to meet the sales targets. Here, the risk culture failed and the control environment failed. There was pressure to meet sales goals and it eroded tactics. The tone at the top tolerated misconduct. Lesson learned? From a COSO perspective, the COSO ERM emphasizes on risk appetite, culture, and board oversight, demonstrate how stronger governance could have prevented this misconduct. In its absence, we had this failure. Organizations applying COSO framework experience tangible benefits. Could be stronger investor confidence, regulatory compliance, operational efficiencies, fraud prevention, or resilience. In detail, the transparent control and risk reporting improves the trust. It simplifies SOX, Basel, GDPR, and DPDP Act's compliance requirement. It helps identify redundancies and streamlines processes. Its proactive fraud risk management reduces financial losses. Better preparedness for disruption like cyber attacks or pandemic helps in building better resiliencies. Modern organizations apply COSO to digital initiatives. Aligning COSO with NIST CSF to design enterprise-wide cyber risk governance helps with the cyber security space. Applying COSO controls to ensure secure access, compliance, and third party assurance helps with the cloud migration aspect. Emerging use of COSO ERM pipelines to define acceptable risk in AI adoption helps with the AI governance space. Integrating COSO ERM to identify and disclose environmental and social risk helps with the ESG reporting. While COSO provides a strong framework, challenge do persist. It could be the implementation burden where smaller firms struggle with the cost and resource requirement. Having a checklist mentality where some organizations reduce COSO to a compliance checklist, missing its strategic potential. Its integration with technology, it's like adapting COSO to AI, blockchain, or 5G requires continuous innovation. So there could be a challenge there. Boards and employee may resist shifting from reactive compliance to proactive risk culture. This is part of the cultural resistance that would generally be experienced. Organization typically follows a five-step roadmap when implementing COSO. The first is compare the current control risk practice with COSO's principle. This is about gap assessment. Step 2 is to develop or enhance control aligned to objectives. This is you're designing the control. Then embed COSO into planning, budgeting, and performance review. This is to integrate with your strategy. Use GRC platform and analytics to continuously monitor COSO controls. About automating monitoring. Then provide transparent reporting to board, regulator, and stakeholders with regular revisions. This is about reporting and improving. COSO is not just an academic framework, it's a practical compass for governance, risk, and compliance. Its 5 component and 17 principles guide control design, while ERM integrates risk with performances. Real world failures like Enron, WorldCam, Satyam, and Wells Fargo shows the devastating consequence of ignoring COSO principles. In practice, organizations that adapt COSO move from a reactive compliance driven mindset to a proactive strategy driven approach, one that balances risk with opportunity and builds resilience in an uncertain world. Challenges and criticism of COSO. The Committee of Sponsoring Organization in the Treadway Commission frameworks are widely regarded as the gold standards for internal controls and enterprise risk management. Yet, despite their global adoption, COSO is not without challenges. Implementation often raises concerns about complexity, cost, adaptability, and practicality, particularly for smaller organizations and in rapidly changing digital environments. A balanced evaluation requires acknowledging these criticism alongside its strength. Perception of complexity. Well, one of the most common criticism of COSO is that its frameworks are perceived as overly complex and resource intensive. The internal control integrated framework, with its 5 components and 17 principles, may appear daunting to organizations unfamiliar with structured governance practices. The ERM framework introduces 20 principles across 5 components, requiring significant organizational maturity to implement it effectively. Example, a small e-commerce startup may struggle to operationalize the ERM framework requirement for governance, culture, performance monitoring, and portfolio risk views when it is still focusing on growth and survival. Well, COSO language and structure are best suited for large, publicly traded corporations with established governance rather than agile SMEs or startups. That's the argument from critics. It adds on to the perception of complexity. The second is cost of implementation. Well, implementing COSO based framework can be expensive. The cost would arise from hiring consultant for gap assessments and implementing roadmaps. The cost arises from training employees and boards on COSO principles, establishing monitoring mechanism and internal audit function, investing in GRC technology platforms to automate COSO compliances. Example, public companies in US spends millions annually on SOX section 404 compliance, much of which involve designing, testing and reporting controls aligned to COSO ICIF. While beneficial, this has raised concern about the disproportionate cost versus benefit, especially from smaller firms. The US SEC has provided exemptions or scaled requirements for smaller reporting companies, acknowledging the burden of COSO based SOX compliance. That's a relief from a regulatory perspective. Although COSO ERMs and updated guidance attempt to broaden the scope, COSO is often seen as being heavily skewed towards financial reporting. The original 1992 ICIF was explicitly designed to address internal controls over financial reporting. SOX compliance further cemented COSO's association with finance. Even today, many organizations primarily use COSO for SOX audit, while broader risk receives less structured attention. The criticism is this finance heavy orientation can make COSO less appealing to operational managers, technology leaders, and strategic planners who may view it as an audit driven compliance checklist rather than a business enabler. Challenges. Well, for SMEs, COSO often feel too formal and resource intensive. Smaller firms lack dedicated internal audit or compliance department. They often operate with lean resources, making it difficult to assign staff to monitor COSO principles. SME may prioritize survival and growth over formalized governance structure. Example, a mid-sized IT service provider might find it unrealistic to implement COSO's 17 principles of internal control when facing budget pressures and competing client demands. Some SME prefer ISO 31000 because it is simpler and less prescriptive compared to the detailed principles in COSO. The rapid phase of technological change present another challenge for COSO. While COSO has issued guidance on cybersecurity, blockchain, and ESGs, critics argue that updates arrive slower than the risk evolve. COSO frameworks were originally designed in an analog, finance driven era and require constant reinterpretation for AI, IoT, and 5G context. Emerging risks are not explicitly covered, requiring organization to stretch COSO's principle for applicability. Example, in AI adoption, COSO ERM principle can help establish governance. But organizations often need supplementary framework like NIST AI RM or for technical risk management. Another challenge lies in the implementation mindset. Many organizations adopt COSO framework formally but not substantially. They complete documentation and process map to satisfy auditors and regulators. Internal controls are treated as compliance obligation, not as a strategic enabler. Boards and management often fail to embed COSO into day-to-day decision making. The result, COSO loses its transformative potential and become a paper exercise. Organizations often operate under multiple regulatory and governance framework. Could be ISO 31000, NIST, COBIT, ITIL, local laws also. COSO does not always integrate seamlessly with these frameworks, thus creating duplication or confusion. Example, ISO 31000 is widely adopted internationally, while COSO remains more US centric. NIST CSF provides far more technical depth for cyber risk compared to COSO's high level guidelines. Organization must often map COSO principles to other framework, increasing the complexity. These are one of some of the criticisms that we encounter. While COSO is widely accepted, some regulators and industries prefer alternative models. In Europe, ISO 31000 often dominates discussion on ERM. In Asia, regulators sometimes prescribe their own framework rather than adapting COSO. Critics argue that COSO's US roots make it less globally neutral compared to ISO standards. However, multinational corporations often implement COSO as a universal internal standard, then map it to their regional frameworks. COSO emphasizes governance, board oversight, and structured reporting. While valuable, critics note that strong governance does not always translate into effective execution. Culture, agility, and innovation sometimes matter more than control structures. COSO may unintentionally encourage bureaucracy if applied rigidly. Example, a fintech startup may need to pivot rapidly in response to market changes. Overly rigid COSO based governance could slow innovation if not applied flexibly. Despite these criticisms, organization can adapt COSO pragmatically. You can apply COSO principles proportionately, focusing on what is material. You can map COSO with other framework to reduce duplications. One can use COSO as a high level governance compass rather than a prescriptive checklist. You can emphasize COSO's focus on the tone at the top, ethics and accountability rather than just controls. You can use AI, analytics, and GRC platform to automate the COSO monitoring, reducing the manual burden. The criticism of COSO highlights an important truth. The framework is only as effective as its implementation. COSO provides robust principles, but if applied rigidly, it risks becoming burdensome, bureaucratic, or finance heavy. Hence, for large corporations, COSO provides unmatched structure, rigor, and regulatory alignment. For SMEs, COSO can be adapted in a simplified form or integrated with lighter frameworks like ISO 31000. In digital age, COSO must evolve faster to address AI, cybersecurity, and ESG risk. Ultimately, COSO's criticism reflects not a failure of the framework itself, but the need for thoughtful, proportionate, and adaptive implementation. Organizations that approach COSO with flexibility can transform it from a compliance burden into a strategic enabler of trust, resilience, and value creation. With this, we'll take a pause here. Lend part 2. We have completed few aspects of the original agenda, part 1 and part 2. We'll take a break here before moving on to part 3, continuing with the agenda as shown in the screen. Thank you for the time that you invested till now for these two parts. See you in part 3. This is your host Savit Vittal Salian. We'll continue our journey. Namaskar.